Hi everybody, and welcome back to video number 7 in chapter 19. And when we left off, we were looking at the pension reconciliation for the Zorro Company in the 4 years 2025 through 2028. And as illustrated here, the first section is the change in benefit obligation. So here they have the benefit obligation calculated for each of the 4 years. And then the second portion of this reconciliation is the change in plan assets. And they've calculated those here, here, and here for the 4 years. So as we subtract the fair value from the benefit obligation, we'll notice the fund status or the pension asset liability change here. So here we have a negative $1,000, a negative $78,600, and a negative $105,400, and a negative $98,900. And So if we look now at the Pension Reform Act of 1974, a classic example of unfortunate consequences of an underfunded pension plan is the 1963 shutdown of the Studebaker automobile operations in South Bend, Indiana, in which 4,500 workers lost 85% of their vested benefits. As a result, the Employee Retirement Income Security Act, called the 1974 ERISA, was passed. ERISA affects virtually every private retirement plan in the United States, and it attempts to safeguard employees' pension rights by mandating many pension plan requirements, including minimum funding, participation, and vesting. So the Pension Benefit Guaranty Corporation, the PBGC, the PBGC's purpose is to administer terminated plans and impose liens on an employer's assets for certain unfunded pension liabilities. And if a company terminates its pension plan, the PBGC can effectively impose a lien against the employer's assets for the excess of the present value of the guaranteed vested benefits. That lien generally has the status of a tax lien. It takes priority over most other creditorship claims. Pension terminations. ERISA prevents companies from recapturing excess assets unless they pay participants what is owed to them and then terminate the plan. As a result, companies were buying annuities to pay off the participants in the pension plan and then used the excess fund for other corporate purposes. Okay, let's put this into practice. And here, the Jablonski Corporation sponsors a defined benefit plan for its employees. And on January 1, 2025, the following balances relate to the plan. So here we have plan assets, the market-related value, the projected benefit obligation, the pension asset liability, and the OCI prior service cost, and the other comprehensive income loss as well. And then as a result of the operation of the plan during 2025, the actuary provided the following additional data at the end of 2025. And here we have service cost, actual return on plan assets in 2025, amortization of prior service cost, contributions, benefits paid to retirees, settlement rates, of 7%, expected return on plan assets 8%, and finally, the average remaining service life of active employees, which is 10 years. So in the instructions, alpha, we're going to compute the pension expense for Jablonski Corporation for the year 2025 by preparing a pension worksheet that shows the journal entry for pension expense. And then under Bravo, we're going to indicate the pension amounts reported in the financial statements. All right, so here is the solution for part alpha. And as usual, we have our annual pension expense, cash, other comprehensive income, prior service costs, gains and losses, pension asset liability, and then our memo records. And we have those calculated here. Okay. So now, if we look at Bravo, we're going to have a pension expense here of $75,700. And you can see that debit of $75,700 here. Okay. And now we'll take a look at this $43,200, and you'll find that little beauty right here on the pension worksheet as a debit. And then our credits include the other comprehensive income, PSC, and that we have, here. And then we have the 13,000 other comprehensive income gain or loss, and we can see that here. And finally, we have the $85,000 cash, which we find here for the credit. Okay, so if you did that all correctly, this journal entry would make sense. All right. Now for the Bravo portion of that, we have our operating expenses, and under that in the income statement, we're going to have our pension expense. It'll be our service cost. And then our other income, or under other income or expense, we'll have our pension expense here, other components here for $30,700. Our other comprehensive income, our asset gain, our amortization of loss, our prior service cost amortization, totaling $33,900. And then on the balance sheet, under liabilities, we'll have our pension liability of $126,800. And in stockholders' equity, we'll have our accumulated other comprehensive loss, PSC, $80,000, and our other comprehensive loss, gain or loss, for $25,100. Okay, now we'll shift gears a little bit and look at identifying the differences between pensions and post-retirement health care benefits. As far as accounting guidance, these rules cover for health care and other welfare benefits provided to retirees, their spouses, dependents, and beneficiaries. Other welfare benefits include life insurance offered outside a pension plan, medical, dental, and eye care, legal and tax services, tuition assistance, daycare, and housing assistance. All right, so as we look at the differences between pension benefits and health care benefits, here, funding under pensions is generally funded. Healthcare benefits is generally not funded. Benefit here is well defined and the level of dollar amount in pensions. For healthcare benefits, it's generally uncapped and vary greatly as far as the benefit. And then our beneficiary here for a retiree may be some benefit due to the surviving spouse, but for health care benefits, normally it's retiree, the spouse, and other benefits. The benefit payable for pensions is generally monthly, and health care benefits are as needed and as used. Predictability. The variables under pensions are reasonably predictable. However, for healthcare benefits, the utilization is very difficult to predict. The level of cost varies geographically and fluctuates over time dramatically, in my experience. Okay, so measuring the future payments for healthcare benefit plan is so much more difficult than for pension plans. Number one, many post-retirement plans do not set a limit on healthcare benefits. Number two, the levels of healthcare benefit use and healthcare costs are difficult to predict. We have increased longevity, expected illnesses from things like AIDS and SARS and COVID, along with new medical terminologies and cures, cause changes in healthcare utilization. So if we look at this illustration, here's our date of hire, age 29, and our prior service cost would go to the planned amendment date at age 34. And then the FASB attribution period goes to age 55. And the beginning of eligibility period would be age 45. And then vesting date would be 10 years later at age 55. And the estimated retirement date would be age 61. Okay, obligations under post-retirement benefits. Here, expected post-retirement benefit obligation, the EPBO, is the actuarial present value as of a particular date of all benefits a company expects to pay after retirement to employees and their dependents. And then number two here, accumulated post-retirement benefit obligation, and that's the APBO, is the actuarial present value of future benefits attributed to employees' services rendered to a particular date. And here is an illustration. Here is the APBO, here's the EPBO, and active employees that are not eligible for benefits are shown here in this blue coloration. The active employees fully eligible for benefits here, and the retirees and dependents receiving benefits are here. And we're going to take the present value of both the APBO and the EPBO of a future benefits at a particular date. Present value of future benefits at a particular date. Okay. So, in defining the obligation for post-retirement benefits, the FASB maintained many concepts similar to pension accounting. It also designed some new and modified terms specifically for post-retirement benefits. Two of the most important of these are the specialized terms that follow. This looks like a good place for us to stop this video, and when we return, we'll take a look at these expected post-retirement benefit obligation and accumulated post-retirement benefit obligation in more depth. Until that time, bye for now.